Welcome to Daily Digests for July 31, 2026. Today brought sudden intraday volatility across U.S. equities, starting before the opening bell. S&P 500 futures dropped nearly 1.2% in a rapid 40-minute window, alongside a sharp leg down in NASDAQ futures. The trigger was not a corporate earnings miss, but a currency market alert. The New York Fed notified major commercial banks to prepare for potential joint market intervention in the Japanese yen. That alert sent an immediate shockwave through the global yen carry trade. Over recent months, institutional investors had borrowed low-yielding yen to finance leveraged positions in U.S. megacap tech stocks and high-yield assets. Rumors of official Treasury action to strengthen the yen forced an immediate unwinding of these carry trades, driving pre-market margin calls and forced selling across high-beta U.S. equities. Despite the sharp morning dip, buyers stepped in near key technical support levels to absorb the forced liquidation flow. Coming on the heels of month-end portfolio rebalancing and institutional fund unwinds, the market digested the initial currency liquidity shock, allowing major equity indices to stabilize off intraday lows as trading progressed. Beneath macro liquidity noise, corporate fundamentals continue to show clear operational discipline. In its Q2 earnings report, Amazon raised its 2026 CapEx outlook toward $200 billion. However, management provided concrete payback metrics. Servers and networking hardware deployed for AWS break even in under 3 years against an operational lifespan of 5 to 6 years, generating an annualized return on investment well above 20%. This capital efficiency was reflected directly in AWS performance. Amazon Web Services revenue accelerated to 37% year-over-year growth, reaching $42.2 billion for the quarter. Strong enterprise cloud demand confirms that heavy capital investments in AI compute infrastructure are converting into measurable cash flow, rather than sitting unmonetized. However, the picture is more complex for platform-layer software and ad-supported content. Google's widespread rollout of AI overviews in search results is absorbing user query traffic before users click through to third-party destinations. Digital publishers and platforms like Reddit face declining direct search referrals, highlighting how generative search is reshaping web traffic flows. This dynamics establishes the central sector divergence in U.S. equities today. Upstream cloud infrastructure providers and custom chip makers enjoy direct demand visibility and clear capital payback. In contrast, downstream content platforms and traditional SaaS models face traffic disruption and monetization friction, driving a sharp rotation in institutional capital. Not all software providers are losing ground. Adobe reported strong Q2 results, with AI-driven service revenue surpassing $500 million and management raising full-year revenue and earnings guidance. Adobe demonstrates that software vendors with deeply embedded enterprise workflows can monetize generative capabilities effectively through price realization. On the macro front, the Federal Reserve's policy framework is undergoing a structural shift. Following yesterday's FOMC rate hold under new Fed Chair Kevin Warsh, the central bank is moving away from explicit forward guidance. Instead of signaling future policy paths in advance, the Fed is adopting a strict data-dependent stance, allowing market yields to adjust freely. Under this new framework, 10-year Treasury yields approaching 4.7% are acting as the primary mechanism tightening financial conditions. For equity markets, higher long-term bond yields enforce valuation discipline, ensuring that market performance must be driven by earnings expansion rather than multiple inflation. Looking across Q2 earnings season, guidance dispersion has reached its highest level in several quarters. Companies capable of demonstrating demand resilience and margin expansion continue to attract capital, while those offering cautious outlooks face swift market re-ratings. Looking ahead to next week, investors are preparing for SpaceX's upcoming first public earnings report. Wall Street consensus projects Q2 revenue of $6.88 billion. Cash flow trajectory for Starlink and operational metrics for Starship will provide the first standardized financial benchmarks for public aerospace valuation. In summary, today's pre-market currency alert serves as a clear reminder of how global liquidity shifts can spill over into equity pricing. As we head into August, market performance will be dictated by 3 core variables: FX carry trade stability, capital expenditure payback efficiency, and the constraining effect of 10-year Treasury yields. Thanks for watching, and we'll see you next time.